Well, welcome back to the Slash Tax Podcast, where we explore the smartest ways to reduce tax legally and strategically, and to reinvest that money into building wealth. Today, I'm joined by someone with expertise in an area that doesn't get nearly enough attention: cash balance and defined benefit plans. So, my guest is Chris Roehm, CFP, partner of CSENG Advisory Group, and a recognized cash balance plan specialist. Chris has over 19 years of experience designing IRS-approved defined benefit plans, helping small business owners, professional practices, and even farm-based businesses defer anywhere from $100,000 to $300,000 annually in taxes, all while building long-term retirement security. He's educated thousands of professionals through webinars and conferences, and he's known for making complex planning strategies understandable, practical, and even fun. That'll be interesting. But Chris, welcome to Slash Tax.
It's great to be your guest, Heidi. I love the name of your podcast. I wish I would have thought of that. It's perfect.
Well, thank you. I appreciate it. Yeah, so for listeners, Chris and I don't even remember how we connected, but it was a long time ago. I would venture to say 5, 6 years ago, maybe. And we've kind of talked here and there, but haven't talked actually in a couple of years. We just recently reconnected. And so, Chris, dive in a little bit. Tell us first off a little bit about your background and
Okay.
your area of expertise before we can dig into this, because this is an area I am not that familiar with, only vaguely, maybe enough to be dangerous. I think that most listeners really don't know anything about this area, but it can be a really nice opportunity for specific investors. So I'm really excited to dive in. I'm going to ask all the questions as if I know nothing, and hopefully that's helpful for people listening.
Well, I think you have it exactly right. I think for most entrepreneur business owners, very few know much uh, about the difference between a defined benefit plan and a defined contribution plan. And if you're talking even about financial professionals, most of them have an idea, or they know what a defined benefit plan is, but they don't have very much experience implementing or designing one. And I include in financial professionals, I would include attorneys and CPAs
Hmm.
in that bucket because, when you pass, for example, when I passed my CFP exam, you had to know what it was. You had to answer those questions, but then you don't see it again unless it's the focus of your practice. Um, and I think a lot of CPAs, I've done a couple of CPA conferences recently, and when they hear defined benefit plans, they don't like 'em because
Hmm.
they remember back in the 70s when they were first introduced, and it was, there was a lot of negativity around them. You started it, they were inflexible,
Mm.
you couldn't shut them down, and then people hear about in the news, or at least they used to, about teachers' unions that had defined benefit plans and the investments didn't perform as well as they were originally intended and designed, so that the sponsor or the union had to put more money in the plan to support it. And of course, it would scare anyone away.
Yeah. Yeah. Well, it'd be interesting to dive into a lot of that stuff. Let's start really high level at the beginning about, in essence, what is a defined benefit plan? Or I think you're calling it a cash balance plan, right? So can you
Yeah,
explain first off for someone who doesn't understand anything about this, what is
yeah.
this?
So I'd call it a cash balance plan now because in the modern design, there are always cash balance plans. And because of that stigma against the negativity that's around the defined benefit plan, I don't call it that anymore when I'm talking to clients or prospects or doing podcasts or any of that. But at the highest level, you have a number of different types of retirement plans that are sanctioned by the IRS. Every once in a while, somebody will ask me, "What's your website?" or "How do I learn about this?" And I just tell them, "Well, it's irs.gov." When I want to be a smart aleck. But if you Google IRS sponsored retirement plans, you come right up to the page where it lists. I think there's 12 or 14 different types of qualified plans or retirement plans. And in general, there's two types. One is called the defined contribution plan, which just about everybody is familiar with. And then you have a defined benefit plan, which just about everybody is not. And so a defined contribution is easy to understand because it's a percentage of your income. And a 401k is a defined contribution plan.
Okay.
A SEP IRA is a defined contribution plan. And it's called that because your retirement benefit is defined by what you contribute, not by what benefit you get at the end.
Okay.
S- So pensions started, back in the old days when you worked for the factory for 30 years and then you got a gold watch and then they paid you a salary continuation or pension benefit after you retired.
Hmm.
And money has to be set aside into these funds so that companies could provide those benefits. Well, those went the way of high button shoes for the most part. And um, but they because they invented defined contribution plans, I think in the middle early 70s when ERISA legislation established the 401k plan. So now the company's saying, well, we're not going to guarantee you a benefit. We're just going to let you put some of your salary away and the IRS won't tax it. And we're going to be a good employee. We're going to match that with 3%. Some exceptional employers will even make a profit sharing contribution, a discretionary contribution to your 401k account. But you're still not guaranteeing a benefit. When you retire, you're going to get the money that's in your account, and that's it.
Hmm.
An additional difference is that in a defined contribution plan like a 401k, you get to choose what you're investing it in. In
Right.
a defined benefit plan, it's the company who's deciding what to invest it in. And in the old days, we're taking all the investment risk because
Interesting.
if the investment didn't match up to what they expected or have enough principal there to pay out the benefit into the future, then those plans got in trouble. They were underfunded. Some went bankrupt, and there's lots of horror stories I don't really know the dates, but the 80s and the 90s, I think, was when
Hmm.
a lot of those got in trouble.
Right. So with a defined benefit plan, it's not set on a set percentage, and then there's not like an employer matching. So who sets up a defined benefit plan? It sounds like it's the employer who's structuring it.
And if it were really simple, it would be easier to explain. But a defined benefit, so the rules are around being able to benefit everybody.
Hmm.
So there's a lot of non-discrimination rules. So not only the highly paid owners of the company, can benefit. So when you set up a defined benefit plan, you can have different classes of employees, and you can say, for Heidi, we're going to pay you 100% of your salary that you had the day you retired until the day you died. But for
Okay.
this class over here, we're only going to give them, 60% of their salary. And then there's a lot of other complicated rules. I'm simplifying it here. And because I don't know all the complicated rules, the answer is you have to be an actuary to set up and design these plans. Um,
Okay. So let me clarify. So a business owner would set up a defined benefit plan, and then they can use that as like a structure of compensation for their employees. So almost like build part of that in as a benefit of being an employee of the company.
yes, definitely. Um, so it's off. An employer would offer a defined benefit plan for a few reasons. But let's be really clear. The main reason is they want to save taxes, and they want
Okay.
to save taxes on their own salaries and their own income. Um, since you do have to include all of your employees in the overall plan, not necessarily in the cash balance plan to the same level that you are, but you have to, there's rules in place to protect the rank and file employees.
Okay.
However, when you have a good company with good employees and you have to offer competitive benefits or they're going to quit and go work somewhere else, that definitely aligns.
Hmm.
That's a great use of a defined benefit or a cash balance plan.
Okay.
And
Why does it create a tax benefit? Where does that tax benefit come from in setting one of these up?
so let me back up just a little as I didn't do a complete job of answering your first question about how you set up how you decide how much you can contribute, how much you
Yeah.
can deduct. So I often use my brother as an example because he's a union elevator mechanic
Okay.
and he has a pension from the union. They're going to pay him what I think it's around $4,000 a month from the day he retires until the day he dies. But if you're an employer, you're not going to pay your employees more than they made when they were working,
Hmm.
right? And then everybody would just retire. So you get a percentage of your income. And in the case of the elevator union, I don't know what it is. Let's just say they can be complicated formulas. More than one is allowed in when you're calculating what these benefits are going to be. But the idea is you're defining a benefit. So let's go back to you. We're going to pay Heidi Henderson a benefit of X thousand dollars a month from the day you retire until the day you die. And we're going to, there's rules around how you can define that. The simplest way to explain it is one of the rules you're allowed to use is you can take your average income from 3 consecutive years, and we can base the benefit on that. So
Okay.
let's say you made $100,000 a year for 3 consecutive years, then we could pay you up to 100% of your salary. 'Cause you're the owner of the company. We're designing
Hmm.
this with your guidelines. If you were designing for your employees, you might say 60%. But since
Hmm.
we're trying to get the biggest tax reduction, we're going to pay you 100% of your salary from the day you retire until the day you die as a pension benefit. Now you have to hire an actuary because there's a few things that normal people don't know. And that is how long you're going to live. And but now the IRS has mortality tables for that. But
Hmm.
normal people cannot do the math. You have to be an actuary that says, what is the lump sum that you would need, that Heidi would need to have in her defined benefit account the day she retired so that it would have enough money to pay out. Let's just say that $4,000 a month uh, from the day you retire until the day you die. And so let's say you retire at 70, and let's say your life expectancy would be 90. It's probably like 86, if I
Hmm.
remember what the tables are. 4,000 a month, call it 50,000 a year from, well, I said 100,000. Let's use that. 100,000 a year for 15 years, 16 years. So that's going to be $1.6 million. Now
Okay.
you need an actuary to say, what's the present value of that? But not just the present value of that lump sum. What's the present value needed to produce that cash flow? So what's the present value of that future expected cash flow? And then
Hmm.
they do all their formulas and they say, well, Heidi's allowed to have $900,000 in her defined benefit plan because that's enough to pay out $100,000 a year for 16 years after she
Okay.
retires. Right?
Yeah.
Complicated.
Okay. Yeah. And why is that? Where's the tax benefit in that?
Well, the benefit is, aha. So now and now you're going to retire at, I'm using an example that you're a lot older than you really are. But so let's use my
That's okay. I'll
brother.
take it.
Let's use my brother as an example. So my brother's 60. He's going
Hmm.
to retire at 65.
Okay.
And we need this. We know that we need, let's say, $1 million in the account the day he retires to fund that future benefit. But
Hmm.
wait, he's only got 5 years until he retires and he hasn't put anything in yet. So you only have 5 years to fund this. And so, the simple math would be it can put $200,000 a year in. Now it's a
Okay.
little more complicated because it's the present value and you have to assume some growth and so forth.
Yeah, but for
But you
easy
get the
easy
idea.
math, that makes sense. Yeah.
Yeah. So you're allowed to contribute $200,000 a year for the next 5 years and deduct that from your income. Now that's way more than you can put into a regular IRA, considerably more than you can put into a 401k plan, even if you're the owner and giving
Yeah.
yourself the maximum profit sharing benefit. You're only going to get around $70,000 into a defined contribution plan in any given year.
Okay. Is there a max contribution in a cash benefit plan?
There is.
What is
So
that
where does
number?
this come from? This comes from, if the IRS is giving you a good deal, it's never unlimited. So the IRS, in their, ageless wisdom, they've come up with 2 ways of calculating what's the most you're allowed to put in. First of all, is you're only allowed to assume that you earn so much in salary. That's indexed every year for inflation, but I think this year it's like $265,000.
Okay.
No, sorry, $345,000. That's the
Okay.
most salary income that you're allowed to use to calculate the benefit. Then there's
Okay.
another rule, if it's not already confusing enough, there's another rule that says the maximum pension benefit that we can ever pay out is that $265,000 per year.
Okay. So even though the highest salary cap is 345. And so what is that then limit on the contribution? Are you limited in the is the annual contribution limited to what that highest salary amount is, that 345,000?
You would think so, but it's not quite. Because the factors come in, your age comes into play. So how many years do you have until retirement? That's a big deal, because the closer
Mhm.
you are to retirement, the more you can contribute, because you've only
Mhm.
got a short time to fund this. And then the younger you are, the longer you're going to live. So the younger you are, the longer you'll need to pay out that maximum benefit every year. So the perfect spot where you can put in the maximum contribution is somewhere around age 65. So if
Okay.
you're 65 and you only have, let's say, 5 years until retirement, and you're going to live, a full life expectancy, and you've earned that $345,000 a year for 3 years, you're going to qualify for the maximum benefit. Now, because you're so close to retirement, and don't quote me on this because it changes quickly, and you have to be an actuary to really to sign off on it. But it's somewhere over 600,000 a year that a 65-year-old in the right circumstances can contribute to a plan and deduct all of it
Okay.
from their
So
income.
that would be a full deduction against income. And that's
Yep.
at the business level or the personal level?
It's at the business level. So all qualified plans are sponsored by the business.
Okay. And then isn't there some requirement that if you create a cash benefit plan that or cash balance plan that there has to be benefit for all employees of the company?
Yes.
Okay. And
Yeah.
so if somebody owns a business with a bunch of employees, they have to structure this plan and there has to be benefits, but then they can essentially define what the benefit is for all employees
Well,
under
yes.
that
And
plan.
you're getting to the limit of what I know, because you have to be an actuary and you really have to read all these documents and stay up on all these regs. So I have a great team of actuaries and plan designers behind me, but I've done over 100 of these plans in the last 4 years. So what I'm giving you is mostly correct. And it's what you said in my intro, is that I can take something complex and explain it.
Yeah.
And so now I forgot your question. Oh, you don't have to include everyone because there's rules, but there are rules to protect the rank and file employees.
Okay.
And some of the
S-
interesting things are you can always discriminate against family members. So if you employ family members, you don't have to include them in your plan.
That's funny.
If there's partners and owners in the business, you don't have to include them in the plan in most
Interesting.
cases.
Okay.
Yeah.
So, a question for you then, because when I'm dealing with just assuming my listeners, I mean, number one, I deal with a lot of accountants, a lot of CPAs, and I deal with a lot of real estate investors or small business owners. When people are looking for a tax strategy and they're understanding what the benefits are for them as a high income earner with a high tax liability, this
Yep.
has come up a few times for some people where they're like the ideal candidates. So,
Yes.
will you talk a little bit about what is the ideal? Now, yes, I think we could structure one of these for a large business that have lots of employees and it's a big complex
Yes.
plan. I think in reality, what I've actually seen is that these are small business owners who are setting this up for their own future retirement planning, because a lot of times
Yes.
entrepreneurs don't have some type of retirement plan. They're just
Correct.
betting everything on the fact that, oh, I'm just hoping I'm going to build a successful business and maybe when I retire, I'll just sell my business and I'll have some
Yes.
money, but they don't save. I mean, I have a lot of friends that own businesses. Typically, none of them have a 401k. They haven't really invested or saved. They've put everything into their business, which is a great business. Maybe they're
Yep.
making, a million or $1.5 million, $2 million a year. Maybe. I mean, that's like their gross revenue. These are small companies, right? Anyway, I think that there are some benefits to that type of a business owner that
Yes.
has the value of reducing their tax payments now and allowing them to save for future retirement planning. So, talk a
Yes.
little bit about that. Who is that ideal person
Yep.
that I think this is probably best suited for?
Yep. So you nailed the demographics of my ideal client. Let's say they're making three, four, $500,000 a year of income,
Hmm.
and maybe they're 60, and they haven't saved for their own retirement because they've been putting all their money back into their business, and they're buying more machines, they're buying farmland, they're hiring employees. Takes a lot of capital to not just start but to grow a business over the years.
Yep.
And they've always said, yes, my business is my retirement. I'll sell it one day. But so they haven't put a lot away. Um, so along comes this idea where you can really catch up your retirement funding in a big way at the right time when you're not slowing down, but you're not investing all of your capital back into your business so that you have the cash flow to be able to fund this. And in the ideal situation, you wouldn't have any employees so that you didn't have to provide any benefit for anyone but yourself or your
Okay.
family members.
But just
Now,
for the record, so for someone who owns a business and maybe it's a person and their spouse and they kind of run the business themselves, but they don't actually have employees. I actually see that a lot. They have
yeah,
contractors and all kinds of expenses, but not actual payroll. This
that's
could still
perfect.
work for them, right? Yeah. Okay.
Yes. Now, it works for a lot of businesses with employees too,
Hmm.
and I'll
Hmm.
talk to that a little bit. But first of all, you can exclude anyone that doesn't work over 1,000 hours. I mean, if anyone you can exclude anyone who works under 1,000 hours per year. So
Okay.
part-time people, you don't have to include, which is why I think restaurants mostly hire part-time employees because they don't want to provide them healthcare benefits and other benefits. I'm not
Yeah.
sure
Yeah.
about that, but it seems
Yeah.
that to me.
Hmm.
Um, and uh, so an employer company, you own a company and you've got two or three employees, and the younger they are and the lower paid they are, the less you have to contribute for them, right? Because it's the opposite of what I was saying. When you get close to 65 and you're making a high income, then you have to contribute more, which you want to do because you're deducting that. But on the younger, lower paid employees, it shapes up really well. You don't have to contribute a lot for their benefit. And the other strategy I haven't mentioned yet, but yes, you have to include them in the cash balance plan. Not all the employees, but a certain number of them. There's a lot of rules, very complicated. But typically, we set up in conjunction with the cash balance plan a 401k profit sharing plan as well, and
Oh,
that's because the owner can contribute to the 401k profit sharing plan, and that is less out of pocket contribution than it would be if you included all the employees in the cash balance plan.
okay. Okay. Interesting. Okay. So you have a business owner. They can set it up. This is creating a tax benefit, a deduction for whatever
Mhm.
they're contributing into this cash balance plan. And then
Mhm.
that's building. So the business manages the funds in that account. So they still maintain control of assets. Is that correct? They still own
Yes.
them and those are invested as they see fit to just kind of continue to grow that money. Uh,
So own them is a little bit strong of a word.
okay.
It's a trust, and the owner of the business or the sponsor of the plan is the trustee of that trust. Some of it is their money, but some of it is the other employees' money. So they don't own
Right.
it, but
Right.
they are in control, and almost always they're fiduciary on that
Yeah.
investment.
Perfect. Thanks for clarifying. Yeah, of course, when they've got employees and some of that
You
money
knew
is
that. I just
essentially,
wanted to, yeah.
yeah, yeah, earmarked for those employees. Okay. What happens when they sell the company?
So haven't had that happen yet. Um, it's a complicated question. I don't exactly know the answer, but let's say in the simplest case, you can always shut the plan down, and then
Okay.
all the cash balance that's in the plan just rolls over into your personal IRA. So it's when I said it was a
Well,
complicated
well,
question
but
is
yeah, but how does that work when you've got money in there earmarked for employees?
so that's a great question. Let's come back to when you sell the company. But the beauty of the cash balance plan is it's a hybrid between a defined benefit and a defined contribution plan. So
Okay.
you're allowed to contribute as if you were going to pay out a pension benefit in the future. But when you decide that you don't want to sponsor this plan anymore, or you sell the company, or you reach retirement age, or or it's fully funded and you're not allowed to put any more in, you can shut the plan down. And when you do that, all of the participants, the owner and the employees, they get the cash balance that's in the plan. So
Okay.
these are typically never going to pay out a pension because
Mhm.
that would be complicated. And the hybrid nature and what takes away the investment risk is, yeah, we were planning on paying you this, 100,000 a year as a benefit, but we don't really want to take that risk now, so we're just going to give you the cash balance that's in the plan.
Interesting. Okay. So if the company sells, in theory,
Yeah,
high level idea, conceptually, uh, it would essentially be like the employees. So let's say that the founder of the company has built this company. They're an entrepreneur. They build
yep,
it. They go out and they sell the business. They
yep.
decide we're selling it, and in the process of selling it, we're going to shut down the cash balance or defined benefit plan. Then, in essence, it's kind of like the employees get a buyout. I mean, not really, but kind of,
Well,
right?
they
Because
get the
wouldn't they
balance
get
that's in their
they would get
plan.
some benefits in the plan. So it's kind of like,
Yes.
hey, the company's selling and it's kind of like you get some proceeds.
Yes.
Um,
Now, it's already theirs, whether they sell or not, if they're
huh,
vested, and it's usually a 3-year vesting cliff. But
okay.
in the bigger companies, that's why I said I want to come back to it. In a bigger company where ongoing benefit to these employees and the employee retention and all those things. So in a bigger company, and there's giant cash balance plans out there. Some of the biggest law firms in the world have cash balance plan for their 1,000 attorneys.
Hmm,
Even if they sold, you could keep it going too, but that's a complicated thing. It's a big issue in due diligence if you're buying a company that has a defined benefit plan because you want to make sure that they're in compliance and that they haven't been cheating their employees out of contributions, or there's a lot of way beyond the scope of my knowledge that you have
hmm,
to be careful if you're buying a company with any kind of a qualified plan. Yeah.
huh, okay.
Yeah.
Yeah, interesting. It is indeed sounds very complex.
You can always
Um,
shut it down though, right? You can always close
yeah.
the plan down and then sell the company.
And what are the rules with shutting it down? Why would someone shut it down? So let's just say I actually had a client. They had a construction company, got this
Mhm.
set up, thought it sounded like a great plan. We'll need to get to what all this costs because for them it was expensive. It was
Mhm.
complicated. They did set it up. They started using it. And then a few years later, they were like, this just isn't working like we had thought. They actually had misunderstood the implications of it, not realizing that they would have to actually contribute for all of their employees and said, "Hey, we got to get out of this thing." And it proved to be very difficult to unravel.
Yeah, I'm not sure what the circumstances were in that case, but it doesn't have to be that complicated. And
Okay.
all qualified plans are assumed to be permanent when you set them
Mm,
up, but permanent intention doesn't mean that you have to keep them forever. So there's you can shut a qualified plan down, including a cash balance plan, anytime you want for any valid business reason. You
mm,
just can't do it for tax purposes only.
right. Okay.
Just like anything, if I take you
Yeah.
to lunch and because I want to do a cash balance plan, I want you to hire me to do your cash balance plan. If we talk about business over lunch, I can deduct the lunch. If we just go have lunch and we don't talk business, I'm not supposed to deduct that lunch. So
Hmm.
every deduction that you take in the tax code, there has to be a specific business purpose for that.
Absolutely. Right.
Yep.
And that's something I talk about a lot with my clients and then also on this podcast is that the IRS specifically says that with any plan, with anything that we do as taxpayers, if it is recorded on a tax return, the onus is on the taxpayer. That means that as the taxpayer, it is your responsibility to make sure that you are working with reputable advisors, that you are
Yes.
working with people that are experts in their field, and understanding that unfortunately, not all players in the space are at the same caliber or credentials in terms of understanding the implications of some of these strategies, especially
Yes.
complex strategies, which this is kind of what I talk about on this podcast. So
It's
it's always
complex, but it's I think I was talking to a 12-year-old at a holiday party a year ago, and like the adult said, "Wow, that's complicated," and the child said, "Well, not if that's all you do." you know, it was a good insight. Um,
Yep, that's a
and
good point. That's a good point. So,
You know,
Chris, I
a lot
think,
of things. Last point on this. A lot of things in the tax code you're familiar with that the IRS comes out with safe harbor guidelines and
yeah.
rules, and they put it on the dirty dozen list, and they make it a listed transaction. Well, cash balance plans have never approached any of those areas. So
Hmm.
we wish, in some cases, we wish there were safe harbor guidelines that said if you start one, you have to keep it open for 3. There's not. There's no guidance. There's really not much out there on that. So
Okay.
the best ERISA attorneys that I've spoken to agree that 2 years is the minimum
Hmm.
because in the language it says years plural means
Hmm.
2. But then everybody who does it thinks like 3 is a very good minimum. 5 is
Okay.
certainly even safer. Yeah.
Okay. Understood. I think in looking at your resume, you've worked with a bunch of farm-based businesses. Is that right?
Yeah. So in the introduction, you were saying it's been 3 or 4 years since we spoke, and um, one of my clients is a celebrity in the world of agriculture, and
Okay.
he hired me to update his estate and tax plan, and in the process, I told him about cash balance plan, and he says, "I'm going to promote you to my audience." I'm like, "What do you mean audience? You don't have an audience?" He's like, "Aha, I do." He sent out an email, and we get 200 farmers to show up to my webinar. So
Cool.
in the last 3 years, I've installed over 100 plans for farm. Well, it turns out that uh, it just fits their situation. You know, they
Okay.
don't like to pay taxes like any other entrepreneur. They want to be legit. They have invested in farmland and equipment for all these years, but as they're getting towards retirement, they don't have those expenses. They don't have these write-offs. They've done all their cost segregations on all the buildings that they put up, and they've taken advantage of all those things. And they're out of ideas. And they haven't saved for their retirement, just like you said.
Hmm.
And they have a lot more income than they've ever had. And they're in the higher tax bracket than they've ever been in. And so it's a perfect storm. And
Hmm.
um, that's probably why I've done so many farmers recently.
Okay, good to know. So that's very entrepreneurial as well. Typically, these are individuals that own their own company, their business, or their farm agriculture. Typically, have very few employees, or
Typically
just have
none,
contractors.
right?
Or if they have any, they're part time, so probably
Or
don't have to
family
be
members.
included. Okay,
Correct.
yeah. So it
All
really
those things.
gives them the ability to create a cash balance plan for themselves and
Yep.
their family through the company with a large deduction. Really, they don't have to be guaranteed contributions for anybody else in most cases, right?
Yeah, it's very flexible. That's the I spoke at 2 of these conferences. They were advanced CPA type conferences, and
Hmm.
they just don't realize that how much flexibility there is in designing these modern plans today.
Yeah.
Secure Act and the Pension Protection Act, and there's been a number of other, some guidance and some direction from the service that's it's it's very flexible now how you can set up and manage these plans. Yeah.
Interesting. Did the one big beautiful bill make any changes at all to this type of a structure?
I'm 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 sure it has some implications. It wasn't a big thing that we had to jump out and do a webinar on right away. The qualified business income is I think the one thing that the big beautiful bill changed is they defined more of like what's farm income and what's not farm income. That was probably the biggest impact on my practice. But
Okay.
otherwise, no.
Okay.
Probably something else I'm forgetting, but it wasn't anything major.
Okay, so another question. You talked early on about the IRS scrutiny against these and kind of the not the negativity, but the what was the word you used? The stigma
Yeah.
around defined benefit plans. Tell me a little bit more why, because I find that, we see that in my space, we see some of the stigma against sometimes maybe an R&D credit or certain things
Yeah.
even that have been on the Dirty Dozen list. So for listeners, the
Yeah.
IRS puts out a Dirty Dozen list every year. It is the top 12 things on there that are essentially what they define as their Dirty Dozen. These are the things that are
Abuse,
the
tax
most
yeah.
abused tax
Yeah.
strategies they see. I actually just did a video post yesterday where the IRS just published a notice on social media. By the way, I did not follow the IRS on social media. Did you know they have an Instagram and Facebook account?
I missed that.
Yeah, me too.
Mhm.
Apparently they do. So they posted a thing and they said there have been $163 million in penalties assessed this year for erroneous claims for credits and deductions that the taxpayers were not eligible for. So
Yeah.
essentially fraudulent claims
Mhm.
coming from social media. That was their post. So
Oh, okay.
$163 million in penalties assessed against strategies that people had found on social media. So
Mm.
it's funny because I do a lot of social media now, and I use this podcast as a platform for educating people about tax strategy. And I think it's really important to dive into the things we need to look out for because
Yeah.
with everything we do, it's about making sure that we're doing it correctly, that we're following
Yes.
the letter of the law, and we're not being abusive with it. Because for some reason, it seems like there's always abuses. There's always somebody ready and willing to jump
Yep.
onto some strategy and go totally overboard to
Yes.
inflate the numbers or to do something that's really aggressive that then
So
falls outside the boundaries. So let's dive into that for a
couldn't
minute.
agree more. But here's a little nuance. The IRS it doesn't really scrutinize cash balance plans at any high level that I'm aware of.
Okay.
Now, what's
Has it
interesting
ever
though,
been on the Dirty Dozen list?
no, not that
Oh,
I'm
good.
aware. I don't think
Okay.
so. No,
I
I
didn't
mean
think so either, but I thought it was
it
since we brought it up.
it's the kind of thing that everybody supports because it
Hmm.
it benefits the owners and it benefits the rank and file employees to a
Good.
large extent.
Yeah.
Now, I'm not necessarily I wasn't a huge fan of the Governor Walz from Minnesota, but he came out during the presidential campaign. He said, "I think everybody should have a defined benefit plan," and I think
Wow.
that's my guy. Yeah.
Can I follow you around, please, on your campaign trail?
But the nuance here is, and I learned this from speaking at these tax professional events. Yes, the onus is on the taxpayer to make sure that
Mhm.
they don't cheat. But I
Yeah.
think it's really there's so many CPAs and tax professionals out there that are really the enforcers. They're the
Mhm.
ones who try to make sure that their clients don't cheat. Way
Isn't
more
that the
than the
truth?
IRS coming in. And
Yeah.
so that's the audience that I need to reach is that they've got a misconception that these plans are somehow not just not that they're targeted by the IRS, but because they think there's too many rules so that there could be a problem.
Mm.
And like you said, the construction company that started the plan for the wrong reasons and then they had to shut it down. There's
Yeah.
a lot of stories about that and people remember those. And but they're not designed and managed by someone with a lot of experience or knows how to customize them, in my
Got it.
opinion.
Got it. Okay.
Yeah.
Okay. Well, that's fair. It's so interesting with these things, and I like to dive into it and just understanding, those things to, I guess, be aware of. So, given the fact that the IRS has, it sounds like pretty clear guidelines in terms of how much is someone making in terms of their salary, what's their income, in terms of how the calculation is, what the caps are for how much could be
Mhm.
contributed on an annual basis. What are areas where abuse could occur or might occur?
So I'm going to answer that a little bit of a sideway and to make sure I come back to the abuse. The biggest problem isn't really abuse; it's mismanagement. So let me come
Okay.
back to the mismanagement. In researching this and learning all I could about this for the last 3 years, I'm kind of a geek, so I'm reading all the IRS forms and I'm reading all their guidance and all their letters that they put out. And sometimes the instructions on how to fill out the different tax forms are quite good. And there's a line on almost every type of income tax return that says pension and profit sharing plan contributions. So you
Huh.
read the instructions on that and then you dig down and just about when you think you're going to get to the place where they tell you exactly how to calculate how much you can contribute. Right when you think you got it, it says, this is beyond the scope of this document. You have to hire an actuary to tell you how much you can contribute. Yeah.
Of
So,
course. That's the
but the
complications of the tax code.
I know, right? The abuse, I don't think, well, I guess there is one area of abuse that I haven't seen it, but I have heard it discussed, at conferences and thrown around, and that is someone who has a giant ear. So
Mhm,
let's say you're a lawyer and you have a wrongful death case and you have a $5 million settlement,
mhm.
and they go out and they form a cash balance plan because they want to contribute, they want to defer the tax on this $5 million, and then the very next year they shut it down. I think that would be the best case. I mean, that would be an easy case for people to understand that that might be abusive.
Yeah,
Yeah,
right. Yeah, right. Because then they're basing their contribution limits on a super highly inflated,
right.
I guess, compensation model for that year.
Right.
Mm,
If
okay.
you're doing it, if I were out here promoting this, saying, "Hey, you had a giant year farming,
Mm,
let's do a defined benefit plan. You can shelter all this income, and next year you'll shut it down. We'll shut it down." The service would come after me for that, right? They come after people promoting tax, ideas just for deduction purposes. And
Yep.
then I think the tax professionals are really wary about that too. Like you
Yeah.
say, they see stuff on social media. Um, and not everybody has the level of expertise and authority behind what they're doing. So they that is the scrutiny, that they're trying to protect their clients from tax scams. Yeah.
Yeah,
But the
absolutely. I
biggest
agree.
danger for really getting spanked by mismanagement of a cash balance plan is if you overfund it.
Okay.
So remember the limits,
Mhm.
that you can only. Well, the Wall Street Journal had an article on cash balance plans on March. I think it was March of 2025. I forget what day. And it there is a maximum lump sum based on your age and your income that you're allowed to have, and it changes by the day almost because life
Mm,
expectancies change, interest rates change. But they said it's somewhere around $3.5 million for a 65-year-old today. So you could
okay.
put 600,000 in a year for how many years? You got about 3.5 million in your account. You should stop contributing to the account because if as that investment grows, and if you had put it in Nvidia stock 3 years ago and it tripled,
Mhm.
you might have an overfunded plan. And one thing you don't want is to have an overfunded plan because when you do take it out, it's like a 50% excise tax
Oh.
on everything that's overfunded. So
Oh, wow.
you don't want to let these plans get overfunded. That's the
Mm,
biggest. That is the real risk, but we're not seeing a lot of that
mm.
um, today. Uh, just because I've only been doing this 3 years, it probably takes 3, 5, 8, 10 years until you get a plan that's overfunded.
Yeah. Okay. Well, obviously another reason why it's so important to work with an actuary or work with someone who is knowledgeable, educated, and can help manage these plans,
Yes.
because I'm sure they're a bit complex. Before we wrap up, tell me a little bit about the cost for structuring something like this.
So there is there is a upfront cost and there's also an annual administration cost. Now, I tell the story years ago when these big law firms first formed their defined benefit plans, where these big companies were doing it, it cost $50,000-$100,000 because you had to draft these plans from scratch.
Hmm.
Um, and you had to hire a law firm, your ERISA attorneys, but now the IRS has pre-approved forms.
Oh.
So, you can get the pre-approved forms as long as you don't change them. They're fill in the blank and check the box. Then the plan is automatically approved. All qualified plans of any kind have to be pre-approved by the IRS before you can implement them. If you use their pre-approved forms, you're good. So most places are going to charge between, $1,200 to $2,000 for to set up the plan design. And even when
Okay.
you're using the pre-approved forms, they're 100, 150, 200 pages sometimes.
Hmm.
So, 1,000 to 2,000 to set up a plan well
Hmm.
within reason. And then
Yep.
the annual administration is somewhere around $2,500 per year because there's all
Hmm.
the actuarial calculations that you have to do. You have to file a 5,500 informational tax return. There's a lot of documents that you have to produce and keep on file to show how these actuarial calculations were done, what all your assumptions were, on and on and on. Now, most CPA firms don't want to file the 5500s. And so most good plan designers will include that in their annual fee to file
Okay.
the tax return for them.
Oh, nice. Okay. Okay.
Yeah.
So does it have its own tax return, or it just has does that tax form attached to the corporate return?
It has its own form. It's a
Oh,
it's a
okay.
form 5500.
Okay.
It's just for qualified plans. There's rules about who has to file it and who doesn't.
Okay.
Um,
But I
and
mean, the question is, does it get filed separately? Like, is it sent into the
yes,
IRS as a separate document? Okay,
yes,
separate from the actual business or partnership return. Hmm,
correct.
okay,
And
interesting.
really even the even the best tax professionals, all they want to know is who's filing the 5500. Most of the time, they don't even want to see a copy of it. Um,
Well, it's similar. We do the Form 3115 when we're dealing with cost seg, or the forms for
eh,
R&D tax credits are very similar. The CPAs don't really, if it's not their area of expertise, it's best to have someone do it that's really
yeah, they
specialized in
can't
that.
charge enough to learn how to do that, and yeah,
Yeah,
you just
right,
need to have
right.
somebody that does it all the time. Yeah.
Well, perfect. Well, Chris, thank you so much for being here and sharing this information. Of course, we'll keep all of your contact information in the show notes, and I'm always here to answer questions. I have a lot of clients that are always asking for different strategies and understanding how things like this can play into their overall tax plan and tax structure. Any final thoughts or comments for listeners as to how they can reach you if they want to get more information?
Sure. You'll put my contact info on the slides.
Correct.
My email and my phone, 954-239-7344 is my direct line. And I just got approved by NASPA to give continuing education credits on this topic. So any
Very
CPA
good.
that wants an hour of credit, all you have to do is spend 50 minutes on a webinar, and I'll go through this with you, and you can learn about it, and you get an hour of CE credit.
Perfect. Wonderful. Well, that is wonderful. Yes, we do a lot of NASPA credits as well, and that's a great resource for CPAs. Well, Chris, thank you so much for breaking this down so clearly. Cash benefit and defined benefit plans are such powerful tools, but I think really underutilized, especially for the right type of a business owner. For our listeners, the takeaway is this. If you're a business owner or high income professional paying six figures in taxes every year, there are IRS approved strategies that can defer those dollars into your own retirement instead of sending those to the IRS. If you'd like to connect with Chris, he shared his information, but we'll also drop his contact information in the show notes. You can also reach out to me directly for any questions on your overall tax plan. This has been another episode of Slash Tax. Be sure to subscribe, share this episode with a colleague, and keep listening to learn how to slash your taxes legally, ethically, and strategically.
Thank you, Heidi.